If you've been following the financial news lately, you've probably noticed a lot of buzz about certain stocks making waves in the market. Headlines are popping up everywhere, social media is abuzz, and it seems like every financial influencer has an opinion on what's hot and what's not. But with all this noise, it can be tough to separate the hype from the real opportunities. Today we're going to break down some of the most talked about stocks right now. Ryde, PTL, APVO, MRIN, KWE, and NWGL, and help you figure out if any of them deserve a spot in your portfolio. Whether you're a seasoned investor or just starting out, understanding the story behind each stock is key to making smart decisions. So let's dive in and take a closer look at what's driving the excitement and the risks behind these companies. The big question on everyone's mind is simple: is now the right time to buy, or should you hold off and wait for a better entry point? Maybe you're wondering if it's time to cash out and take your profits, or if you should double down and ride the wave. These are the kinds of decisions that can make or break your investment strategy, and they're never easy, especially when emotions are running high and the market is moving fast. But remember, investing isn't about chasing the latest trend or following the crowd. It's about doing your homework, understanding the fundamentals, and making choices that fit your goals and risk tolerance. So, let's get right to it and break down these stocks one by one. We'll look at what each company does, what's driving their recent performance, and what you need to watch out for before making a move. First up on our list is Ryde Group, a name that's been generating a lot of interest lately. Ryde Group is all about revolutionizing the way we move. They're a transportation technology company that's trying to carve out a niche in a crowded and competitive field. Think ride-sharing, smart mobility solutions, and cutting-edge vehicle technology. Their mission is to make urban transportation more efficient, sustainable, and user-friendly. But here's the thing: the transportation tech space is packed with big players and well-funded startups, all vying for a piece of the pie. Ryde has some innovative ideas and a growing fleet, but they're up against giants like Uber, Lyft, and a host of international competitors. The question is, can they stand out and capture enough market share to justify their current valuation? When you look at Ryde's financials, you'll see that their growth trajectory is impressive. Revenue has been climbing steadily, and they've managed to expand into new markets faster than many expected. Their partnerships with local governments and tech firms have given them a leg up in certain regions. However, the competition is fierce, and margins in this industry are notoriously thin. Investors need to keep an eye on how Ryde manages costs, scales its operations, and differentiates itself from the pack. If they can execute on their vision, there's real potential here, but it's not without significant risks. Next up is PTLE, or PTL Limited. This company operates in the engineering and manufacturing sector, providing essential products and services to a wide range of industries. Unlike the flashy tech startups that grab headlines, PTLE is more of a steady, reliable performer. They focus on building high-quality components and systems for industrial clients, and their reputation for reliability has helped them secure long-term contracts with major players in the field. PTLE's business model is all about consistency and incremental growth. They're not chasing the next big thing or trying to disrupt the market. Instead, they're focused on doing what they do best and doing it well. For investors, this means you're unlikely to see explosive gains overnight, but you also don't have to worry as much about wild swings in the stock price. PTL's financials show a pattern of stable revenue, solid profit margins, and a healthy balance sheet. If you're the kind of investor who values predictability and steady returns, PTL might be right up your alley. There's something to be said for the peace of mind that comes with owning shares in a company like PTL. You won't be glued to your screen watching every tick of the stock price, and you can sleep a little easier knowing that your investment is backed by real assets and a proven track record. Of course, the trade-off is that you probably won't see your portfolio double overnight, but for many investors, that's a fair exchange for stability and reliable dividends. On the flip side, if you're looking for excitement and rapid growth, PTL might not be the best fit. The stock tends to move slowly, and major catalysts are few and far between. It's the kind of investment that rewards patience and a long-term outlook rather than quick trades and speculation. So if you're in it for the long haul and appreciate a boring but dependable company, PTLE deserves a closer look. Now let's shift gears and talk about APVO, Aptevo Therapeutics. This is where things get a lot more interesting and a lot more volatile. APVO operates in the biotech sector, developing innovative therapies for serious diseases. The biotech industry is known for its high-risk, high-reward nature, and APVO is no exception. Their pipeline includes several promising drug candidates, and the company has attracted attention from both investors and industry insiders. Investing in biotech stocks like APVO is not for the faint of heart. The potential rewards are huge. If one of their drugs receives regulatory approval or shows strong results in clinical trials, the stock price can skyrocket in a matter of days, but the risks are equally significant. Drug development is a long, expensive, and uncertain process, and setbacks are common. A failed trial or regulatory delay can send the stock tumbling just as quickly as a breakthrough can send it soaring. For those willing to take the plunge, APVO offers the kind of upside that can transform a portfolio. If one of their therapies hits the market and gains traction, early investors could see substantial returns. The company's management team has a track record of navigating the complex world of biotech, and they've secured partnerships with larger pharmaceutical firms to help bring their products to market. But make no mistake, this is a speculative play, and you need to be comfortable with the possibility of losing a significant portion of your investment. If you're considering APVO, it's important to size your position appropriately and be prepared for a bumpy ride. Diversification is key, and you should never put all your eggs in one biotech basket. Keep an eye on upcoming clinical trial results and regulatory milestones, as these events can have a major impact on the stock's trajectory. And remember, even the most promising biotech companies face hurdles that are often outside their control. Moving on, let's take a look at Marin Software. This company operates in the digital marketing space, providing software solutions that help businesses manage and optimize their online advertising campaigns. In today's digital-first world, effective advertising is more important than ever, and companies like MRIN play a crucial role in helping brands reach their target audiences. Marin's platform offers a suite of tools designed to streamline the ad buying process, track performance metrics, and maximize return on investment. They've built a loyal customer base among small and medium-sized businesses, and their technology is constantly evolving to keep up with changes in the digital landscape. However, the digital marketing industry is highly competitive, with major players like Google and Facebook dominating the space. MRIN has to work hard to differentiate itself and maintain its relevance in a rapidly changing market. Despite their innovative technology, MRIN has struggled to achieve consistent growth. The company has faced challenges in scaling its business and capturing a larger share of the market. Revenue growth has been sluggish, and profitability remains elusive. For investors, this means that MRIN is something of an underdog, a company with potential, but also significant hurdles to overcome. If you're the type of investor who likes to root for the underdog and is willing to take a chance on a turnaround story, MRIN might be worth keeping on your watch list. But for most, it's probably best to wait and see if the company can deliver on its promises before committing any serious capital. Keep an eye on their quarterly reports and any news about new partnerships or product launches, as these could signal a change in the company's fortunes. Now, let's talk about KWE, Kwesst Microsys. This company operates in the defense technology sector, developing advanced solutions for military and security applications. Their products range from smart weapon systems to communications technology, and they've managed to secure a few government contracts that have put them on the radar of defense industry watchers. While KWE's technology is impressive and their government contracts are a positive sign, the company is still relatively small in terms of revenue. The defense industry is notoriously difficult to break into, and winning large contracts can be a slow and unpredictable process. For now, KWE is a speculative play with the potential for significant upside if they can land a major deal or expand their product offerings. If you're willing to take a calculated risk, KWE could be a sleeper hit. The company's management team has deep industry experience, and their focus on innovation could help them carve out a niche in the defense tech market. But as with any small-cap stock, there are risks to consider: limited resources, reliance on a few key contracts, and the ever-present possibility of delays or setbacks. If you decide to invest, make sure you're comfortable with the level of risk and have a clear exit strategy in mind. Last but not least, let's take a look at NWGL, Nature Wood Group. This company is focused on sustainable wood products, catering to the growing demand for environmentally friendly building materials and furniture. As more consumers and businesses prioritize sustainability, companies like NWGL are well positioned to benefit from this trend. However, the sustainable wood industry comes with its own set of challenges. Prices for raw materials can be volatile, and the company's profits can fluctuate with changes in demand and supply chain disruptions. While NWGL's commitment to eco-friendly practices is commendable, investors need to be aware that the stock price can be as unpredictable as the weather. If you're passionate about sustainability and willing to ride out the ups and downs, NWGL could be a good fit for your portfolio, but don't expect smooth sailing. So, what's the bottom line? Each of these stocks offers a unique opportunity and a unique set of risks. Ryde is a bold bet on the future of transportation, PTLE is a safe haven for steady returns, APVO is a high-stakes biotech play, MRIN is an underdog in digital marketing, KWE is a speculative defense tech company, and NWGL is riding the wave of sustainability. Before you invest, take the time to research each company thoroughly, understand the risks, and make sure your portfolio is diversified. No stock is a guaranteed winner, and the best investors are those who stay informed, stay patient, and stick to their strategy. Happy investing.